commercial property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
Good everyone, how you going? It's Phil Tarrant here. Thanks for joining us on Inside Commercial Property. It's Rethink Investing. Rethink Investing. Who's Rethink Investing? Everyone wants to know. Well, I know. I've got a book sitting in front of me here. I do love a property book. I've been known to like property books. Unfortunately, or thankfully, there's a lot out there, but not a lot in the commercial space. So in my hot little hands, here is a book recently published. I'm told I've been given the first copy, so I feel quite special. Maybe that's just trying to make me feel good or not, who knows. But it's called Rethink Property Investing, Become Financially Free with Commercial Property Investing. And it's by Scott O'Neill and his partner, wife, Mina O'Neill. I got that right? I'm getting nods here. This will be part of Inside Commercial Property, where we have a look at how you can go about building wealth through commercial property. Most people kick off resi if they're investing in property and then move into commercial. Some people just focus on commercial, but I think what we have here is a book which probably goes through all of it. I haven't looked at it yet. I've read the table of contents, and I just wanted to pick through it today in his podcast to quiz Scott on some of the lessons that he gives through 200 odd pages here. Scott, how are you, mate?
Very good. Thank you, mate.
Is this your first book?
First and probably last. I don't know. It's a bit of an effort.
Mate, they reckon everyone has a good book in them at some point in their life. And I know a lot of people chase the dream of some point writing a book. So you've got it. Here you are, and you're not yet 40 years old. I don't know how old you are. You're not yet 40, are you?
No.
Pretty cool.
Yeah. So, I remember years ago when I was sort of at that bridge, do I go into more residential? We had quite a few at the time, but the yields were getting quite low and banks were starting to sort of close the door on us a little bit. And, I just wanted to build an income out of property. So that was the goal. And I tried to learn more about commercial. It was so hard. Like there was barely an article on it. There's a lot of stuff in the US, and I was reading US articles about, multi-family type sites and all this stuff that really isn't that relevant to Australia. And it was painful, to be honest. And I remember I was researching for about 18 months before buying a commercial property. So that always stuck with me. I thought, if there was a good book out there that summarised it quite well, that's what I always thought we'll do one day. And here it is.
Here it is. Well, it looks nice. Feels good. You haven't scrimped on the printing of it. It looks like you spent a few bucks on making this all right. Wiley publisher, it's pretty fancy, international publisher. They're banging down the door. There's no one doing this, right, really, in Australia, the whole commercial property focus.
Yeah, and look, the good thing with like Wiley is they will put the book in overseas channels. So, it doesn't mean people are going to find it easy to buy in Australia. It is quite difficult if you're an overseas resident. But, it's just, I just like the idea of getting it out there. It's just a, different experience. Probably, like I said, probably won't do it again. But, it's a very thorough book. It covers all the basics you need to know about commercial property. It sort of highlights Mina and I's transition from residential to commercial, which should resonate with a lot because there are some commercial books out there, but they're not real. They're just talking about, all the summary of, what different asset classes. And, you get that from this podcast. But we sort of try humanise it a little bit. But, it does have all the nuts and bolts in it that you need.
Well, I look forward to reading. And there's a section in this, Scott, that I want to get into today, which is sort of probably the tactical part of it. Part 3, which is our top 5 property plays. So we'll go through them as part of the show. Did you find it quite cathartic writing it, or did it just become a chore eventually?
Oh, it was tough because I'm quite time poor with running a business, and it would be just at night, very late. I'd probably lost my 10 to 11 p.m., 11:30 p.m. every night for many nights for probably 12, 18 months. It was sort of little chapters here or there. But the hardest bit was just trying to get it all in order, because it's easy. It's all in our head. My wife wrote half the book as well. She talks a lot about the managing of commercial properties, her background and just her side of things with property as well. And, just consolidating it in an easy way. And Wiley was good like that. Like they're very pedantic type company. They've got their own style of writing. So it had to fit in with them as well. And I guess that's why they're a big publisher. You need to fit in with their style as much as ours. So, it was tricky, but, it felt like just a big uni assignment that had no ending.
Never. And can you go through this now knowing what bit you wrote and what bit Mina wrote?
Yeah, generally. Yeah. So,
but I can't tell, can I? It's a real partnership.
No, exactly. And that was the goal because, this industry is full of, individuals talking about how they did it. And at the end of the day, we weren't an individual. We were a partnership. You know, I met Mina before I even owned one property, and, you know, we owned all of them together. And if your partner's not on board, you're probably not going to be a full-time investor. The partner has to be on board. And we were rent investors as well. You know, we avoided buying the house in Sydney for about 29 properties, I think, from memory. So we bought all these investment properties before the house to live in, and that was hard. If I had someone sort of nagging on the shoulder to say, investing stupid, stop wasting your money, we can't see it, the result would have been very different. So it's important to look at it as a partnership, I think.
So you can get this now. It's in bookstores. It is available.
It's
maybe,
gonna be,
Nelly, by the time this airs?
Probably, yeah.
Probably.
So it's out in early April.
Okay. All right. Well, there we go. And just the back cover says, make a smart move to commercial property investing. So obviously you've got an agenda. You think commercial property is better than resi properties? Yes or no?
Right now it is, yeah.
Okay, right now it is. And that was a very diplomatic answer. And it says, property investing is so much more than what you see over your back fence. Rethink Property Investing will revolutionise your investment strategy by opening the door to commercialise property investment. From corner stores to medical properties to warehouses, commercial property can lead to considerable financial success if you do it right. Filled with real-life experiences, practical tips and personal stories, this one-of-a-kind guide will show you the concrete strategies and techniques all the Scott and Mina O'Neill used to build a commercial property portfolio valued at more than $20 million and reveal how you can achieve their success too. Whether you're an established investor or just starting out, Rethink Property Investing gives you the principles, plays and mindset you need to make your mark in commercial property investing. So go and grab it. We're going to go through some of the plays, part 3 in this particular book today to give you a bit of an inside view, but we're just probably we'll cover it off and give you a bit of a sense for it all, but go and get a copy. Hey, Scott, I was just checking us out on the, iTunes podcast player on my telephone, some of our reviews, which I just wanted to acknowledge. I'm happy to report, though, 2 things. I'd like to see some more reviews than 41 ratings. I think we're better than that, mate. So let's try and, if you're out there and you listen to this, can you do us a favour and jump on whatever player you're listening to? Most of you probably listen on the Apple stuff. Can you give us a ratings? But the good news, out of the 41 ratings, all of them are 5 stars. So that's a good thing.
Good start.
And I'll just read some of the feedback we're here. Heading 5-star. This is from BMC. Thanks. Without a doubt, the most informative podcast available on commercial property. Keep them coming, mate. That's obviously directed at you. It's probably all directed at you. I hope I'll mention some of these. Great work, guys. Okay, there's 2. So welcome back, guys. Great opening episode to start off the year. That's from Camo. That's Camo Love with a love heart is your name. Thanks, Camo. Great resource. This is from Brad's 350. Thanks, Brad's 350. Very informative podcast covering all things commercial property. Although I invested in this asset class before, I learn something new with every episode. Scott is very generous with his knowledge and offers great education on the topic. No sales pitch, just quality. That's cool. Another one here, best commercial property podcast. That's great. This is Hit the Mark. More, please. Can you do it more frequently? Has changed my perception of this asset class, and as I pivot away from residential to capitalise, I think, on a few commercial properties, expanded my mindset. So that's all good stuff. What we're doing, Scott, sounds like it's resonating, right? So I'd probably give us a tick on the objective we set out to do. It sounds like we're changing and helping frame people's investment decision, expanding outside of resi. Commercial property isn't for everyone. We've spoken about that before, but it's good to know we're doing good. Now, part 3, our top 5 property plays on new book, Rethink Property Investing, available in all good bookstops, probably online as well, Amazon, all that sort of stuff. Let's go through these, mate. I think it's a really good way for us to shape the sort of next, half an hour or so. Play 1. Okay, there's 5 plays. What's a play? A play is like you're channeling your American football, saying this is, you got your playbook, which is normally a secret book that's all dog-eared and scraggly, that's got the coach's super plays, because in American football, unlike, I'm going into an analogy I know very little about, but I'm going to stick with it, unlike rugby or league, which is a lot more fluid, it's very structured the way you play. You do a play. People have a particular role to play at a particular time to do a particular thing to achieve a particular outcome, i.e. a touchdown. Yep. So you're channeling that. That's where plays come from pretty much, isn't it? Exactly.
So one of the things that people don't do well with investing is they're buying because they're generally seeing that's how, like, the market's growing, or it's a good area to buy because it's got a train line being built. Like, they're very loose plays, So this is a play is like a direct way of achieving an outcome. So our plays are, play 1, how to build a, say, $100,000 passive income. Now, it doesn't have to be 100. It's just it's a starting point. It's a goal that so many investors have. If you can build a 6-figure passive income, you've got the option to step back from work, maybe work 3 days a week, maybe even quit and live somewhere cheap. It's all relative. But this is where commercial is quite good because it's a goal to build an income quite quick. Play 2, how a property can pay itself off in 10 years. So you can't do that with 70, 80% debt with residential unless you're chipping in huge amounts of money yourself. So commercial property has the ability to pay itself off. And that is a strategy many of my investors have, particularly when they buy in a super fund. So they might debt up and then, they've got 10, 12 odd years to pay it off and then they're retired and then they've got a debt-free commercial property. It's a direct strategy or a play. Adding value, this is play number 3, adding value through commercial property leases. Everyone likes a value add. You don't need to get too tricky with this stuff. Sometimes a value add can be as simple as extending a lease or increasing the value of the lease. So we look for properties that have that value add opportunity because it's low risk. You can see it with comparable rents. We'll go into it a bit more, but it's a definite play you should consider. Play number 4, check the numbers or you may overpay. Now, it sounds obvious, but because the value of a commercial property is so closely aligned to the income, what if you're going to underestimate it? All of a sudden you've overpaid for the property. So we'll go into that more. And play number 5, syndication, pros and cons and how you can make money out of it, why it may be lower risk or higher risk, depending on how you look at it. So again, it's a different strategy, but it's relevant to certain types of people.
Did you write part 3? Is this your bit?
Yep.
Okay.
Yep.
All right. So you know it. You've done your homework.
Yes.
You've done your homework.
Yep.
So this goes back to, this analogy of a play. Most people have a playbook, right? And you go, here's our playbook. What does it mean? This is the way we go about doing stuff here to achieve the outcome. Now, in property investment, particularly with commercial, most people's outcome is having more money in a real simple way, right? They have more money and then to do insert whatever you want to do with it, right? So a lot of these plays are very much driven or directed towards achieving that outcome, giving people the scaffold or the architecture to go about being a successful property investor. So if you're not yet doing this, this is the intersection between strategy and tactics, and we've spoken about that before. Get comfortable with those terms. There's a whole bunch of stuff around it. You need to understand the difference between goal setting and goals, as in what you want to get, and then how do you actually get there. So this is really going to be working at that level plays. What play are you going to use in order to achieve whatever outcome? Now, play 1, how to build $100,000 passive income. I'm not going to say too much in this because people are going to have to go out and buy the book because that's all the information is. But I'll just read the first para. Set it up. Of all the property questions we're asked, this is by far the most popular. Middle income earners are understandably fascinated by the prospect of retiring early from the workforce, and $100,000 per annum passive income is a common objective. It seems to be the magic number for many, whether they're seeking early retirement or the flexibility to work or not to work as they choose. All right. Now, this is a lot of spreadsheets and stuff in here with percentages, and that looks pretty confusing. What's the base philosophy to this play? Because it could be $100,000, it could be $1 million, horses for courses, right? But what are you trying to achieve with this particular play?
So the idea is to point you in the right direction to build an income. So we've actually the numbers of this, I always like explaining things with examples. That for me is the easiest way to understand these hypothetical things. And the hypothetical scenario is how to build $100,000 passive income the most efficient way as possible. So
what is passive income? Let's just cover that off.
So passive income is the income after your mortgage, insurances, maintenance, everything. You're basically netting $100,000 in your pocket, which you can go spend.
So it's beer money.
That's exactly. It's your monthly income that's going to keep you living after you stop working. So it's very important. If you don't have a passive income out of a property portfolio, it probably isn't a retirement property. You're just, you're waiting for it to grow down the track and working while that happens. So once you've got that passive income, you might be able to actually step back from work. And that's very powerful for many, and it changes how you view life and view your workplace. And, you might take different hobbies up, different types of jobs that you might prefer, not just chasing the salary. So it's a big thing. And commercial property, and I've actually used this example comparing it to residential where, in a spreadsheet, we've got a $2 million property collecting $160,000 rent with a rental management cost of 5% per annum. So long story short, after you minus a 70% mortgage out of that and all your costs, you're left with $103,000 income. So your deposit on that is about $600,000 all up. So you can create $100,000 income with 600,000 cash deposit. I know you might say, oh, who's got 600 grand in the bank? Well, a lot of investors listening to this show would have many times that equity in their portfolio, and I bet you they're probably not getting 100 grand out of their 600,000 investment. So it's return on equity. And if you go down the typical residential model that I followed, that you've followed, everyone follows, you need a bit of residential. So we're not ever discounting residential. This is just what you add on top of it to turn it into a proper income producing portfolio. But if you go out and buy $2 million worth of residential property and have no debt on it, and you've got, a 4% gross yield, and then you've got all your rates and insurances, and pretend you bought three $700,000 properties. After you minus all those costs, 3 sets of rates, 3 sets of insurances, rental management, you're only going to be left with 58 grand. So this is the real kind of summary of this chapter. Would you rather $2 million of debt-free property only collecting 58 grand, 1,000 income, or would you rather using your 600 and a bit of debt to produce over 100? So you can see it's multiple times better cash flow. And, not many people have $2 million of debt-free property. That's the hardest bit. So it's actually very hard to retire purely from residential. And this is what a lot of people don't think. They're always thinking, how do I buy the next property? Not many people retire from it if you do that.
Yeah, and that's a good point. So, the question I was going to ask, because you're talking about what the purchase price is, what the annual rent is. So income, annual rent. You haven't sort of got any depreciation benefits there. That depends on who you are and the way you got your stuff structured. And a cost being interest and a cost being rental management. So there's no other cost to apply per your example here.
Yeah, if we've commercial, the tenant pays your outgoing. So generally they'll pay one property holding of land tax. Rental management is often passed on too. So that's, and a lot of people self-manage commercial because if it's a good tenant, there's really no work. But let's assume you're paying someone, there's 8 grand of rental management there. But all your other costs like insurance, strata if applicable, that's all the tenant. So you're really just dealing with interest. And that's the biggest difference with commercial. Like, number one, the yield's better, but you don't have all those outgoings. And, if I've got massive maintenance outgoings with all my residential properties and, that's what eats away at your cash flow.
Yeah. Okay. Good lesson there. Play number 2, Scott. How a property can pay itself off in 10 years. All right. It's interesting. In a perfect world, you're right, we have our investment properties lined up in an easy set and forget format. We'd sit back and pay them off effortlessly every month until the debt disappears. Unfortunately, this will remain a pipe dream if you haven't set up your investments the right way. Obstacles have a habit of cropping up when you least expect them, and you will need to be able to cover them. You could end up having to shell out more than you thought, and this could easily chew into your cash reserve, especially if your goal is to follow us over the fence and pay your property off in 10 years. How do you do it?
So again, it's going to be one of these hard to explain things, but
read the book, right?
Yeah, it's
some graphs and charts
and examples.
Yeah.
So we've got this calculator. It's on the Rethink Investing website. We call it the Rethink Financial Calculator. It's just a real simple tool to show you what would happen if you buy a property for X amount of dollars with a deposit of, say, 30%. You can change the deposit percentage, and you put your extra purchasing costs in there, and then you put your expected net yield and rental increases in it. And what this calculator does is it graphs the payback period of the property. So using the example listed in this book, and you can put any price in the calculator, but we've gone with $1 million with a 30% deposit. So there's a $700,000 debt there. Now, the income from that property, $70,000 income per annum, net yield. So that means you're collecting effectively $70,000 income, but you've got to minus your cost off that. And using this example, you're starting off with 700 grand debt. By year 10, it's down to 0 because you've had that 70,000 per annum increasing by 3% per annum. And then if you're assuming you're putting all that rent back into the loan. So this is not going to work if you're spending your rent.
Okay, so this is where you talk about passive income being the money you're left over. You're saying you're using that to invest back into the asset itself to pay down the debt.
Yeah, so it's not a strategy that everyone follows. Like, it's probably more of a common one for super funds, because you just want to get rid of that debt nice and quick, and then by the time you're retired, it's debt-free. Most people in reality will go, well, if I'm saving all this money per annum, I'm going to save another deposit and buy again because this is working. That's the true outcome that most people do. But if you're in your late 50s and you've got a real strict, mantra to get your debt to 0, You can do it in 10 years by just putting the rent back in, and you'd be doing it at the same time you're still working, probably, because you're not living off the income.
Yeah.
And people feel safe with no debt. I think debt is a very good thing in this market. You're mad not to have any debt because the cost of funding is so cheap, and it doesn't look like it's going to go up quickly anytime soon. So, it's probably a strategy for those who just really need to get the debt down for whatever reason. But commercial property pays itself off because the income is that good. That's what the message is.
Yeah, and a tip here says your next moves, which is after every sort of sub-chapter here, you give some tips on what to do about it. You say pick your properties with high yields. It goes without saying that the higher the yield, the faster you can reduce your debt. Just be careful not to chase a deal solely on the basis of high yield. This might lead to a risky purchase. So there's always this relationship between yield versus capital growth, right? And per your graph here, you want the property, you want to be buying well so it's going up in value. At the same time, you're driving down, you're building greater equity into it, not just off the capital growth, but also by paying down the debt. That's the secret. All right. Play number 3, adding value through a commercial property lease. We've spoken about this before on Inside Commercial Property, and you can go back to some of these episodes, but this is a good little condensed part of it. This property play is about drilling deep into the lease and the type of asset that will deliver you a value add opportunity. Over the years, we've developed our own preferences and recommendations, and we're excited to share them with you because not all commercial properties are created equal. You'll find that going about it the right way, including taking account of our recommendations, could mean the difference between you're getting an okay return and an outstanding one. Okay, what are your recommendations on adding value through a commercial property lease, Scott?
So, like I said in that intro, we like finding properties that are under rented. Doesn't need to be a big, perfect long lease. So sometimes it's nice to have a lease that needs a bit of work on it because you get it at a discount. We've always brought up, I guess, certain types of assets we see as risky, like maybe the service station on a 15-year lease, and you overpay for it because how do you add value to a 15-year lease? Like, it's only going to get shorter over time.
Yeah.
And once it's only got 3 years left, you're shaking in your boots going, are they going to renew? Are they going to reduce the rent? Is there a need for fuel in 15 years? Like, these questions will, you're going to lose value as you get closer to that expiry date.
Yeah.
But if you buy a property that is not far off the expiry date and they're going to stay, and you can kind of rejig the lease in the due diligence phase or shortly after you settle, then you're adding value. We're making it a stronger asset. So it's like a renovation for a commercial property. We're renovating the lease. That's the same analogy. And you don't need to build things. You don't need to get too tricky or, too cute with the property. It's literally just polishing up of the lease, and you can do your background research in the due diligence phase. And we find that's a very effective way of adding value. But at the same time, you don't want to just buy a weak lease and take a risk and the tenant might go vacant. So you've got to be careful.
You've got to be careful. And you've got some good case studies in here. One is an industrial site attracts 8.1% net return. Another case study, shopping centre purchase for 11.8 million, attracts 8.22% net return. And an office space with a secure government tenant. So some really good case studies. Veterinary centre purchase for 1.125 million with an 8.35% net return. Well, you're not messing around with this section. There's plenty of detail in there, mate.
Yes, these are all client purchases, and they're all within the last 12 months. So they're not dated numbers. Like there's some good numbers in there, but they're all within the last less than 12 months.
Yeah, which is reflective of the market we're in right now. And in the your next move section, always invest in properties that can be easily relet. If you are not confident that you can replace your tenant within a few months, and maybe the rental market underpinning your property's value isn't strong enough. It's basic stuff, but a lot of people overlook it, right?
Yeah, 100%.
All right, play number 4. Check the numbers or you may overpay. Pretty important stuff. Before you're ready to give up residential for commercial, you need to be sufficiently educated to identify the risks. But this is tricky when there's so much misinformation about commercial property ready to trap the novice investor. Like any type of investing, the risks are there, but it's all about identifying them and managing them to better your chances of making profit. It goes back to Resi, Scott. We all know the numbers, right? Most residential property investors have between 1 and 2 properties. The main reason is because not that they don't want to own more property, it's because they probably bought the wrong property first off, and it's just stifled their opportunity or their ability to invest more in property. Same applies in the commercial because no doubt people overpay.
Exactly. And we're seeing, especially now, the market's hot and there's a bit of stupid in the market at the moment where people are just
It's a lot of stupid in the market
stupidly buying things and cash offers, the lowest yields we've seen. Like we even seen some buyers agents that are jumping into this space and, they're buying in flood zones and, they're buying like really basic stuff, but they get attracted to the clean lease. And this is probably the biggest trap, which is sort of a little bit what we discussed in that previous chapter.
Yeah.
They'll see a 5-year lease and go, oh, that's great. Let's go pay $100,000 too much for it. But the lease might be baited. It might be inflated by the owner. It might be it might literally be a tenant that won't last the 5 years because it's just not a strong enough business. So the lease is only as good as the business in the first place. So people right now are sort of desperately trying to get into commercial as they are with residential. And because of that, we're seeing rushed buyers. And that's probably one of the biggest messages we'll always take. Just don't rush this space. Like, there's too many moving parts for commercial. Like, you're not just buying into an area and getting a building and pest report.
Yeah.
You're buying into it. You still got to get your building and pest report, but then you've got to check the legalities of the lease. You've got to make sure the business is in an upward trajectory market. Like, are there any government incentives that could hurt this business 5 years down the track? Are there new suppliers on the way that are going to knock this guy out? You really got to understand the business side of things too. And in a hot market, it's hard to get all that. We find it difficult. It's hard to get all the information in time to make an informed decision. Imagine you're just out on your own, you see a good property on the weekend and you see a strong lease. You're just going to buy it because you've been waiting for a while. And that's a big mistake.
It must be a bit of a double-edged sword for you because you've been very active and vocal in this podcast and the other work you're doing to help educate investors to realise the opportunities with commercial property investment in lieu of other asset classes, and that's really cool. But in doing that, you're creating more people who are interested in commercial property, and there's also an emergence of more buyers agents who are now focusing on commercial. So the work that you're doing is just making your job harder.
Of course. Yeah. And look, it sort of happened, we were in the residential
Which is
space.
a good thing to do, to be honest with you, but you're creating more competition.
100%.
You're manufacturing more people who want to invest in commercial property, and you're creating an environment where you have more buyers agents supporting those people.
Correct. And look,
and you're putting a book out telling everyone about it.
I think we've already created probably 5 or 6 competitors ourselves. Yeah. I know you see them out there, but we're not threatened. Like, there's so much work out there, but the reality is it's not as easy as it looks. Like, you get in and you might have a client that says, I want a commercial property, and then you've got to go find the right one. And this is the trick. 75% of what we buy is off market. When it's on market, it's hard. I'll admit it. There's so many buyers, and it's mostly just local individuals. Like, we're not getting beat by buyers agents. We're getting beat by the local who's missed out on 3 properties in a row and he's got a cash offer. So, touch wood, we've got no issues with competitors right now. But obviously that'll grow. But our off-market channels are so strong. We've got good control over that, and it's taken 5, 6, 7 years to build as well. This is not a new thing for us, and the agents know us so well. They tell us who's bidding on the other end. We know everyone in the market in certain areas, and it's kind of funny because we'll always get the last shot at buyers. And that would happen if your mate was if you're trying to buy a house in Marrickville and your mate's the leading auctioneer down there, or guy at Ray White. They'll tell you who's looking around, and it's the connections. And that's the bit. The non-rocket science part of this industry is your connections. If you get access to more properties, doesn't matter how much you know, that's more valuable.
But that's largely the hard bit to cultivate, right? Because the time, energy, effort, the whole relationship building. But the point is, this player number 4, check the numbers or you may overpay. There's more people in the market. There's more people servicing those people in the market. That means somewhere someone's overpaying.
Yep.
Correct?
And we're seeing growth so quickly at the moment. It's almost hard to keep up. Yeah. So yields are getting compressed. So, every capital city is getting compressed right now. So the hardest part of my job is still getting a good yield for good quality property, and we still are. But at the end of the day, the numbers are too good versus the current interest rate. So this was naturally going to happen anyway, whether or not we're talking about it or not. There's value there for investors, and that'll flow through into the market. So it's still a good time to invest. It's just you've got to be still careful and not get too cozy with this growth market, because if it stops growing, then what are you left over with? Yeah. And that it's good quality assets are key to that.
And in your next move sections of this particular bit, Scott, it's good to see and like it. Don't be afraid to pay for a buyer's agent to know the market from an investor's point of view better than most. It's a little sell there, is it?
Yeah.
Happy to pay. It's okay. You're allowed to do it.
There you go.
Thought I'd read that anyway. Now, play 5. So this is sort of the last play that you've highlighted in the book. No doubt you've got a huge playbook, right? And that's to that point around using a buyer's agent. What you're doing is you're leveraging their capabilities around understanding how to play a particular market, particular property, any scenario based on their experience. This is part 3, our top 5 property plays in Scott's new book, Rethink Property Investing. Well, Scott and Mina's new book. Sorry, Mina, if you're listening to this. Does Mina listen to the podcast?
No.
She's sick of it.
She's bored of me. Don't worry about that. We'll get her to come in one day.
Yeah, definitely do that. I look forward to it. All right, so this is a popular bit, right? Syndication. What's in it for you? Syndication is a buzzword in commercial property circles right now, and for good reason. Basically, syndication allows you to acquire a portion of a high-value commercial asset and guarantees you a split of the rental income and enables you to shoot higher than your budget would otherwise allow. Sounds good, right? So is syndication essentially leveraging you up into different types of assets, really?
Yeah, and in a real good or tight market like this, again, you can actually use, say, a fund manager to get you into a good quality property with a lot less time and effort. So syndications are pretty much just managed funds, but there's different levels of them. It might be just a bunch of 5 blokes who all know each other, chuck in a few $100,000 each and buy a much higher quality asset and share the profit, split it 5 ways, split the rent 5 ways and the cost, and that's how it's handled. You can get leverage, like I call it free leverage, so you can get a loan on a property without you applying for the bank because the loan is on the property itself. One of the disadvantages with syndications are your leverage is lower. So again, I've got a lot of clients come to me and say, do I go in with my brother or sister? And I think it's better to go in by yourself if you can get the loan on your own, because you can get like a 70% loan. So to make that really simple, if you've got $500,000 cash, you can leverage and buy a $1.5 million asset. In a syndicate, you're only going to be able to leverage 50%. So you can only control $1 million of asset. At the end of the day, you'd rather control 1.5 million in assets versus $1 million. So that's a big disadvantage. But one of the advantages are you're not just dealing with one tenant or two if you're lucky in that price point. You might be buying a portion of a shopping centre that has a Woolworths in there and 10 other tenants, and all of a sudden your income is very secure. So it's lower leverage, less spread out there, but probably a little bit more consistent in the income side of things. So longer leases, so that's a good thing. Saves time. That's very important in this market where, it's quite hard to locate the correct commercial property. They've generally got properties just waiting that you put your money and pull the funds, and, you can buy them on the ASX. There's Australian Real Estate Investment Trust you can buy into, and then it's like buying shares of a property. It's really as simple as that.
Yeah, and it can, let's be honest, if you have a retail or an industry super fund, you probably already own some commercial property.
Yeah, so well-known names are like Goodman's or Stockland's or, even Centre Group, like places like that are commercial property owners, Westfields. These are probably things you are part own without even knowing it. But a lot of people go, apply to these companies direct and purchase like an exact property, and you're sort of enjoying a smaller property but a larger piece of the pie.
Yeah, and it can get messy, syndication, and there is a whole layers of sophistication when it comes to syndication. Some are really super active and you need to be really involved. Some are very, very passive. But there's a section here setting up syndicate, and this is where things can and can't go wrong or right. Find property partners that share the same goals, pretty important. Work with a highly experienced account solicitor to set up the correct structure, really important. Use your unit trusts to make an offer on a property. Make sure you allow yourself enough time to raise capital, secure the bank loan, important. Work with a skilled mortgage broker who can source the best loan for your syndicate, really important. And, often the best residential brokers don't necessarily also do commercial, so make sure you get a good commercial mortgage broker. Agree to distribute the funds back to the investors each month or quarter and draw up an agreement on how long you hold the asset. Is it hard to unravel syndications?
Look,
can be.
I've been in a syndicate. I've been in a few with some clients, and one of them we actually sold recently, and it was because someone needed their money, basically. Yeah. And rather than buy that portion of the buyer out, the market was hot. We sold, went up 30% in 2 years, so good time to cash out. Yeah. But that's the problem with some of those smaller syndicates. You've always got that unknown divorce or the unknown, someone who needs their money for whatever reason. You've got to deal with that in syndications. When you buy direct by yourself, it's just you. And you don't answer to anyone. It's that. And it's more attractive, but some people like the safety in numbers method. So pros and cons. I think long term, you probably want a little bit of both because it is a safer income stream potentially because you're spread over more risk, but it has its disadvantages, which is probably the leveraging and the lack of control are the big ones.
Yeah, you need to put all that together. So in your next move sections, last point here, which lends itself to that comment, Scott, before joining a syndicate, be sure to compare the returns proposed to those if you purchase the commercial property on your own. In our experience, direct investing can trump syndicate returns.
Yeah, and there's a little table in there again where we just show a $200,000 investment in a syndicate. You've got a leverage of 50% and a net yield of 7%. So the direct investment, 7% net return as well. So because of that leveraging difference, once you put all the costs in there, the cash flow, everything's been watered out, you're getting a 19% return on a syndicate with a 50% debt. The direct investment will be 30% cash on cash. So always look at return on equity, and that's where you can sort of cut through these numbers.
Now, conscious of time, Scott, but I was going to ask you this question, but I flicked over the page into the conclusion area, and I don't want to give too much away because we want people to go out and buy this book. We just skimmed through it. 200 pages of gold here. But I was going to ask you the question, which is connected in with these sort of 5 plays that we spoke about. Why invest now?
So
in big, bold writing, it's the right question.
So the biggest thing for me as an investor is there's value in the market right now. So if you look at the cost of debt versus the yields on offer, the gap is too great. To give you an example, debt is looking sort of around, 3% on average for a client. But you're buying a 7% net returning asset, even 6%. You can see that gap, 3% versus 6%. It's a 3% gap in interest. Historically, it's normally about 2%. So there's about a yield compression of a whole percent waiting for you, and that could be 20% growth depending on the yield on the asset. So there's genuine value there that is left to hit the market. So that I think there'll be growth because of that. So you're going to get a free kick with growth. As these residential markets peak, they're going nuts in Sydney and Melbourne, and even Brisbane has had record auction levels. Even the regional areas, they're all going crazy at the moment. The end result of this is there's going to be less value in residential. And I think it's already starting to happen. Like, people can't just keep affording to pay more and more and sending yields to record low levels. They're going to look for alternatives. And what's a nice, easy one? Commercial. And obviously the share market there, like, arguably that's had a real good run since, it's gone up. It's up about 30%, the ASX, from March last year. So that's had a good run. So I think commercial's got an important role to play, and that's why we're so vocal with it, because we're a residential and commercial buyers agency. And I remember when I first started talking about commercial, it was just people were just not open to it, and it was frustrating because, and this is the point of this podcast and the book. We don't mind if there's more people talking about this, because if it's more available, around the barbecue topic, everyone talks about it. It's better for the investors, and it's better for everyone involved, because you need both commercial and residential, I think, and that's where this has an important role to play. So there's an opportunity, and I think even things like the New Zealand, you've seen overnight that they're looking at sort of, you can't claim interest.
Yeah.
Have you seen that? Like, it's like a negative gearing.
Yeah, it's the same thing, right? And it goes to show what legislators can do.
Yep.
So, if you want to sort of make hay while the sun shines, right? There's nothing wrong with that as an adage. But become financially free with commercial property investing. Rethink Property Investing, Scott O'Neill and Mina O'Neill. Thanks for putting this together, mate. I look forward to reading it. We just sort of did a quick sort of synopsis on one section of the book. There's a lot more in here. Go and check it out, whether you get your books from bookshops or from the worldwide interweb, no doubt, being Wiley, which is a really good publisher, is going to make sure this is easily accessible. Thanks for coming in, mate. That was a really good way for us to chat through a whole bunch of themes.
Yeah, very good, mate. And we'll see you next time. And look, if anyone's got any particular topics you want us to talk about commercial, we just reach out to us on the Rethink Investing website or Facebook, because I'm going to try bringing in some clients in the next few upcoming episodes. But yeah, if you want to know anything specific about the market, just let us know, and we'll try to get into it.
Sounds good. Happy to answer questions, do a Q&A episode as well. If you want to send that through, you can do that all through the Rethink Investing website. We'll be back again next time. Until then, bye-bye.